And welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the half hour, AJ Brown. Good morning, AJ.
Good morning, Sip.
I feel like today's the first day we're like back in action with the markets and normality. Would you agree?
That's right. Everybody's back from their vacation. Their heads are in the game, full full speed ahead. And unemployment numbers were released today.
Unemployment was released today, and I think the headline number was that the rate dropped. Right, so that's what average consumers are going to see. That the I think 3.9 is what it went down to.
That's right. But the actual jobs created was a little bit of a miss, right? 199,000. They wanted more like 400 and something thousand. And they also revised the numbers for back in November, and that also was not revised up higher than they expected. So, the average person on Main Street, they like to look at that 3.9 number, the unemployment rate number, and that's good. But the actual, and the way that that economic report is created, they actually do two different surveys. And so a lot of economists and investors and the folks that really delve into the data, they kind of question the way that 3.9 number is created, because it doesn't count people who have taken themselves out of the workforce. So there's an actual another number that's not as publicized called the participation rate, which is at an all-time low, meaning that people are just not working, right? And they don't want to work, or they're not even, in the job force trying to look for a job. And so that's at an all-time low. But people like that 3.9 number because it's really on the low side. In fact, it scares some people, because when you get unemployment too low, then you have kind of a weird market, which I guess you could say we're in. But yeah, we've been missing on job creation. And so I don't know how Wall Street's going to reply to any of this. In fact, it looks like there's a little bit of downtrend going on for the day. But I think there's a lot much bigger things that Wall Street's thinking about, namely inflation, right? Inflation versus wage growth. That's really the topic on a lot of investors' minds right now.
That and just that the markets are at all-time highs in general, and now we're starting to have economic news that's substantial coming in to actually affect the longer term trends. And so you said inflation was the topic from last year, last month, the last couple of months. It's going to continue on, especially as the Fed numbers come out, right? Like I'm assuming that if they're not beneficial to the market, we could see significant downturns because we're at these all-time highs. But go ahead.
Well, I was going to say a lot of people are watching what the Fed is doing, right? The Fed's got two choices right now in their toolbox. At least that's what the commoner knows. The Fed's probably got some other tools up their sleeve, but one of them is the quantitative easing side of things, and the other one is the interest rate. And they're going to be playing with these triggers. But I have a feeling this Fed, even though they're going to act swiftly, hawkishly, they're going to also do it with maybe a little bit of tact and care, not do anything crazy. I mean, I started investing under the Greenspan reign. And I remember right after the dot-com boom, they made some really aggressive changes, which looked like it actually accelerated the dot-com bust. So I don't think anything. I think they've learned from their mistakes in that regard, and as well from the stuff that happened in 2008 with the Great Recession. So we'll see. But with the quantitative easing, that's a big deal, right? They've got a choice to what they've been doing is they've been buying treasuries and mortgage-backed securities. And that basically, I mean, when they buy something, they basically create money and buy it, right? And so they just have like a IOU sheet, and they said, we bought these securities and we paid this amount of money for it, and so just put it on our tab. And so their tab has grown. I mean, it's up in the trillions, like 5 to 7 trillion at this point, where they just have IOUs. They've basically created cash and they injected it in the market by buying these securities. So they've already announced that they're going to slow the buying. They may stop the buying altogether of one or both of those securities, mortgage-backed and treasuries. And then how they start, calling in those chits on that IOU as they start selling those securities back when they think the market is there to buy them. And so that's going to sop up that liquidity. That's one way that they can deal with overinflation, is they can start taking money out of the system. The other way, of course, is making it harder to borrow money, and so they can raise interest rates. I actually think that they'll probably not be as aggressive with the quantitative easing, reducing it, if not stopping it and reversing it, as they will be with the interest rates. I think they're going to do a measured approach. And that's actually the terminology they use. We'll be measured about it. So we'll see.
Yeah, that's going to be on the timeline here the next couple of weeks. The other big news in the headlines is our favorite phone manufacturer, Apple, hitting 3 trillion. What are your thoughts on that?
I mean, and like you and I were talking about before we went live, I mean, it just seems like yesterday that they were 1 trillion and that they were competing with Microsoft to who's going to be the first trillion-dollar company. And now Apple's surpassed 3 trillion. What's interesting is about this phone, right? If you think about it, this phone is not really a phone. It's like a full-on computer in your hand, and the phone is just an app. I mean, there's some specific hardware in here that makes it work like a phone. But, the whole thing about this is Apple's also getting into the market very soon with their first automobile, and they're going with the same approach, right? To them, it's not an automobile first, it's a computer first that just happens to have a little bit of extra hardware in it to make it an automobile, and the automobile is going to be controlled by software. And I just saw the announcement as well that Sony is going to be making an automobile. They just announced that their automobile will be ready in a couple years as well. So, the automobile, the whole definition of what devices are. I mean, you and I don't know about you, but me as a commoner, I call this my mobile phone, but it's really not. I mean,
Smartphone.
it's smartphone, or it's really like a computer in my mind, because I'm still used to like big PCs with hard disks that are only 20 megabytes. I'm from a different era. In my mind, this thing is like a computer from the future. I call it my future computer with the phone app. It's just a software. Phone is just a piece of software. Soon cars are just going to be pieces of software too.
And even on top of that is we've got their cameras. They're full on 4K cameras now. And when you think about these companies, not only are they making the software, the hardware, but they also are creating the content. Apple TV has their own studios, right? Sony is a media company in itself, and now they're going into cars. Amazon sells e-commerce, has a studio. Um, I don't know if that should worry me into the future.
And it's really interesting because these companies actually made a lot of these companies like IBM and Apple and Sony, especially, they got out for the most part of the hardware market. And now they're talking about strategically getting back in.
Interesting. All right. So talking about companies that actually do real things, right? Apple makes phones, Sony makes a variety of things. One of the tickers that we've been looking at over the past couple of weeks that does a real thing is Pulte Homes, the home creator builder here in the United States. That's a very popular in the real estate sector. We've been looking at that, and AJ, you've got an update, you've got a new opportunity. This is something that's on your radar.
Yeah, absolutely. So we talked about Pulte Homes on our show from December 17th. And I wanted to follow up with that with an actual spreadsheet of the trades I've been doing on Pulte Homes. So on December 17th, we gave everybody a headline. We said, hey, get in at Pulte Homes the next time that a retracement to the bottom side is found. And so we found one on December 21st, right? And as much as I had wanted to, I had suggested that people either buy Pulte Homes stock or they go ahead and buy a substitute for that stock, a back month option. There wasn't enough liquidity for me personally to buy the back month option. There just wasn't enough trading on it to justify me, because I was going to be buying quite a few shares, quite a few option shares or contracts. So I went ahead and bought the stock. So on December 21st, I bought 500 shares of stock. It was $52.85. It was just over $25,000 purchase. And then I did exactly like we suggested. Here's Pulte Home. So if you take a look at December 21st, that was this bar right here. So we had seen a reversal. This was something that we had discussed about before, called a fast reversal bar. It triggered my automatic trading software. You know, SIP, that I don't sit in front of the computer all day. I've got my software running. And so my automatic software jumped in on this trade. And then sure enough, it did exactly what it was supposed to be doing. It went up to the top of the channel and started to reverse. And when it started to reverse on January 3rd, just a few days ago, right, Monday, I went ahead and sold my premium. I sold my call for 25 cents. And then I bought some protection with the $55 put expiring out in April for $3.30. And so I've got here in my spreadsheet, this is just working perfectly, because if you take a look at Pulte now, it's retracing back down. And so what's happening? Well, this is the prices from yesterday evening. I haven't recorded any prices from today, but when the market closed yesterday, my call is doing what it's supposed to be doing. It's going down to zero. And if I was to liquidate it now, I'd have to pay 18 cents, but I'm hoping to let that just expire worthless. If I let it go to zero, I won't have to pay commissions on it. So I'll get to keep all that 25 cents per share. That's 25 cents times 5 times 100. Don't forget, every option contract has 100 shares in it. So 25 cents times 500 winds up being a nice paycheck of about $121. But also, because the stock is retracing, my protective put is increasing in value. As of yesterday evening, I paid $3.30 for it. It's protecting me, but I'm going to be able to sell this back at a nice profit. Right now, it's going at $4. It's probably going to be going for a lot more than that. Also, Pulte Home definitely is at a higher price than what I paid for it. So I'm making money 3 different ways here. And so I hope people jumped in on our recommendation, because this thing, and not only that, you'll notice I did one trade on December 21st, and I did, two trades on January 3rd just to protect myself. Now it's just a waiting game. It's just time passing by. I've already accrued over 5% in just a few days.
You know what's always helpful is when you draw the little arrows on the chart. Can you do that real quick to
Yeah,
play that scenario out?
absolutely, absolutely. So when we had this bottom, this is what we told people to do. When there's a bottom, you're going to buy some shares of Pulte, or if you want to, buy some substitutes. I bought Pulte. And then as that thing goes up, you just simply wait. And we already had identified that the medium to long duration channel was ascending. So we said as soon as it tops out, that's when you're going to sell your premium and buy your protection. I sold my premium and I bought my protection. I used this little ruler here to decide. So what I did, and this might be interesting to some of our viewers, what I did is I took this ruler out to the expiration date. You'll notice, let me squeeze this down a little bit. In fact, let me get rid of some of my other indicators. It'll make it easier for you to see. There you go. So what I did, support and resistance of this ascending channel with my little ruler on the expiration date of the option. And I lined up the left of the day that I was getting into it. And that told me exactly where to place my strike prices. So for instance, you'll notice I did a $60 call and I did a $55 protective put when I did my trade. $60 call right here, $55 protective put. My little ruler helps me go out in time and tells me exactly what strike prices to use. It's just pretty smart. And now I'm just waiting. I've got what? It's January 7th. I've got a weekend coming up. I've got another weekend coming up. So I've got about a little more than 10 trading days before my option expires. And the scoop is we sold the $60 call. So long as we're below $60, which it looks like we're going to be below $60 by the time we expire, that thing's going to expire worthless. I'm not going to have to worry about anything. Just time will pass by and that money will just jump into my account on January 21st. It'll be locked in. And then I'll just worry about what I do with the protective put at that point. If this thing comes and hits a bottom and starts going up even before the expiration date, I'll wait that protective put at a huge profit. It did what it was supposed to do. It's protecting me against losses. It's appreciating right now. So everything's working as planned, and I hope people took advantage of that trade. That trade's I bet I wouldn't be surprised if we hit double-digit returns just with a few days of work.
Yeah, and you say a few days, so what is that, like a week, 10 days, couple, 3 weeks?
Well, I mean, the waiting time is going to be from December 21st to January 21st. So it's going to be about 3 to 4 weeks. But the actual work I put into it was a little bit like about a half an hour of thought process on December 21st and the same thing on January 3rd. And now all I do is I just watch my wallet grow.
Wonderful, wonderful. And we're gonna wait for our favorite Friday of the month, right? The third Friday of the month,
Absolutely.
when the coupons expire and you can look for new opportunities. And so another opportunity that we've been talking about and looking at is Mattel. And is there another something else that's brewing over there?
Well, we went ahead and we've been talking about Mattel for quite a while here. So we might as well take a look at it because I've been trading it, and I hope folks that have been following it at least have been paper trading it along with us so that they could see that this stuff does what it's supposed to be doing. So we said, hey, at the next reversal, we're going to go ahead and either short some Mattel stock or we could buy a back month put option. I decided to short the Mattel stock. Excuse me, I have a margin account. And so, there's that's not a difficult thing for me to do. And so if you take a look over here in my log for Mattel on November 18th, we shorted 400 shares of stock at $22.50. And then the same thing. So there was a little bit of thought process on November 18th. And then this one was slower as people have been, sending me emails. This one was slower. It took a while for it to find its little bottom there. But as soon as it found its little bottom, and I'll draw a little line here that shows where the bottom was found. And it's not, some trading strategies, folks, are totally, time specific. You have to find the tippity top and the bottom of the bottom. But not with this. You can be off by a few days. In fact, I was off by a few days and I didn't care about that. The scoop is I came back on December 23rd and I went ahead and sold my put. So in this case, the option premium I'm selling is a put option instead of a call option. I sold my put for 50 cents and I bought my protective call for 65 cents. So same thing. I keep track at the end of every evening. So yesterday evening, I kept track of where this position's at. This option that I sold for 50 cents is currently worth only a nickel, and it's totally going to go down to zero. It's going to expire worthless. Again, it expires on January 21st, but it's already almost worth nothing. And I might just close it when it gets close to nothing. I might not wait for it to expire. But it's already at a nickel. If I wait for it to expire, the good news about that is I won't have to pay any commissions because when things expire worthless, you don't have to worry about selling them. And if you take a look at my protective call, I bought that thing for 65 cents. Not only is it protecting my whole trade, it's also appreciating in value. So when I want to sell it, I can sell it for $1.43. Already, this position's up at about 6% ROI. It was a little bit slower, and folks have been noticing that. But hey, I wish people could make 6% in even a year by putting their money in normal investments. This has been just about a month, right?
Beautiful. Love it. Mattel has been something we've been looking at for, I don't know, since we started the live streams, maybe like two months already, and
Yep.
it's bouncing in between those channels, just like we discussed, just like you discuss in the strategy calls, the mastermind calls, in the workshop that we have daily, which, by the way, I've gone ahead and added the link to AJ's daily workshop. If you want to go into these strategies a little bit more in depth, there it is, broadcasting every day.
Yep.
And so, if people are following along with these trades and they have questions, feel free to drop them into the comments section. While you're there, go ahead and hit that subscribe and like button. Doing our best to continue to provide you with quality content. One thing that keeps coming up in the things that I'm looking at, AJ, is this terminology of naked puts.
Yeah.
And so we were talking before, and you've kind of got a strategy that's very similar. It's just not called naked puts.
Well, okay. So selling naked puts is the buzzword. It comes and goes. I mean, I've been in this business of teaching people how to do options trading since 2003. So every other year, it seems like, people come to me and they're like, naked puts. Can you teach me how to do naked puts? I've seen like a presentation on naked puts. It looks like an easy way to get rich quick. And by the way, people can sign up for free access to our web portal. I'm going to just throw that up on the screen really quick. Here's what happens when you get free access to our web portal. This is the homepage. And if you take a look in this section right here, we actually have a short course that I did a while back, not that long ago, but a little short course on naked puts. Now, I call it what it actually is. It's a cash secured put. So whenever you sell any sort of option contract, you have to think about what that contract is you're selling. You're making a little bit of money, but that money's not for free, right? When you sell any sort of option contract, you're under the obligation of that contract until it expires or until you go ahead and buy that thing back, so you don't have the obligation anymore. And so the obligation when you sell a put is that you will be ready to buy stock or whatever the symbol is. It could be an ETF, it could be an index. Buy those shares from whoever has your contract, and you have to have the cash ready to do that. Now, you could have the cash ready in quite a few ways, but when people are talking about selling naked puts, they're talking about having the cash in your account to buy that. People come to me and they're like, "Hey man, I could sell this naked put and there's very little probability it'll get exercised and it'll be a free $500. It seems like I could get rich quick on that." And they don't seem to understand that the minute you sell that put, your broker's going to come to you and make sure you have enough cash or you have a way to cover that obligation. Even if there's only the slimmest chance that it's going to get exercised, your broker's going to make sure you have what's necessary in order to fulfill that obligation until that obligation is no longer hanging over your head. So I had somebody come to me and he said, "I could make an easy $500 by selling this S&P index covered, not covered, but naked put." And I said, "Do you realize that the minute you sell that naked put, your broker is going to make sure you have $460,000 of cash sitting in your account, and they're going to make sure that they lock that cash up and so that you can cover your obligation?" He's like, "I don't have $460,000. I'm like, "Well, I don't know where you got your news about naked puts, because that's what it is." Now, naked puts do have a good place in my mind. And that's what I talk about in my little short course that people should totally sign up for. All you have to do is sign up for free access to our web portal, and you could do that at our website. Um, but the scoop is if you want to buy a stock, you have the cash to buy a stock. You're like, "You know what? I want to have some Cisco stock in my portfolio." And you just hope to have that for the long term. So you have the cash and you want to buy the stock. My recommendation is to go ahead and use naked puts to buy that stock instead of just buying the stock outright. You can, with a naked put, you can lock in the price that you want to pay. And if you don't get the price you want to pay for that stock, then you get a little premium. So if you don't mind not having the stock right away, every month you can collect a premium until the price that you want to pay for that stock or symbol is met. So that's where naked puts come in handy. When you have the money and you want to add a stock symbol or an index symbol or an ETF, anything that's optionable into your portfolio, that's a great strategy to do. Something that's really funny, and I know we're going over, but we start a little bit later. Something that's really funny is um, that people don't understand about synthetic equivalencies. Their options is so, for lack of a better word, flexible, which sometimes leads to complexity. But one of the neat things about options is that you can create a strategy that behaves a certain way by combining different options and stocks. And you can then create another strategy with different options and stocks that behaves the exact same way. And so that you can go ahead and do one or the other, and it would have the same net effect. And one of those synthetic equivalencies is this naked put that everybody talks about and our favorite covered call. And it's funny because you go to a broker and you talk to them and you say, "Hey, I'd like to be able to do covered calls." And they'll say, "Hey, that's no problem at all. Covered calls are low risk option trades. We don't require you to have much experience to do them. That's a great way to get into it." And you're like, "I'd also like to sell some naked puts, some cash secured puts." And they'll say, "Oh, we don't like our traders to do cash secured naked puts. There's a lot of risk involved. So yada yada yada, right?" And they'll read you the riot act and they'll say, "We like our option traders to have a lot of experience before we allow them to do that sort of trading." In reality, those are the two exact same trades, right? They're synthetically equivalent. And I created this little tool that shows that. For instance, I did a quick example of a side-by-side comparison of doing one of our covered calls with Whirlpool and doing a naked put. So, for instance, last night after the market closed, Whirlpool was trading at $233.75 per share. So, if I was to buy 100 shares of that, I'd be out $23,375. But then I could sell that call. I just picked a random call. This was the February 18th, $230 call. I could sell that call and get a discount, a rebate, if you will, of $1,320, reducing my break-even price. Now, the other thing people talk about is, well, why can't I just sell the naked put? The same naked put, February 18th, 2022, $230 strike price, but I'm going to sell the put and I'm going to make $990. Great. Don't forget, the minute you do that, your broker is going to say, "Hey, you're under the obligation to be able to buy somebody's Whirlpool shares of stock for $230. So you better have $23,000 because one of these contracts that you sold is for 100 shares of stock. So you better have $23,000 in cash." So they make sure you have $23,000 in cash. You get that $900 and $990 credit. Notice that these break-even prices are very close to each other. There's a little bit of slippage, but they're very close to each other, and that's because they're synthetically equivalent. And look what happens. If Whirlpool is above $230 for the covered call, the covered call will expire. I'm sorry, I said above. Below $230, the covered call will expire worthless. You keep your 100 shares of Whirlpool, and you're still at that break-even price of $22,055. On the naked put side, if you're below $230, they're going to exercise your put. You're going to have to give up that $23,000 that they locked up in your account. You're going to wind up with 100 shares of Whirlpool, and you have this new break-even price. Notice in either scenario, you wind up with 100 shares of Whirlpool, and the break-even price, besides the slippage, is just about the same. And then the opposite scenario is, what if Whirlpool is above $230 on the expiration date? Well, that's cool. That means that your call contract would get exercised. That means that the person would buy your shares of Whirlpool stock for $23,000. You won't have any shares of stock left, and you'll be able to keep the difference between your break-even price and that cash flow that they gave you, $945. On the naked put side, your put expires worthless, and so that obligation of having $23,000 in your account's gone. And so you have $990, right? And so for the most part, at the end of this scenario, you both have 0 shares of Whirlpool left and you have a little bit of cash in your account. In other words, these are the same strategy. And a lot of times there are some investors out there that'll just trade synthetic equivalencies. They'll put the two strategies on at the same time, and whichever one gets filled at the best price first cancels the other order. And people do this arbitrage all the time. There's a whole trading around that. But my point is that you have to understand that cash secured naked puts, even though they sound super sexy, they're not any better than covered calls. And the beautiful part about covered calls that we take advantage of here at Trading Trainer is that you actually can separate the buying and the selling of the premium, the buying of the main underlying symbol and the selling of the premium on 2 different dates and 2 different times. And so you can actually shop around and get the best, lowest price when you're buying the stock. And you can shop around and get the highest price for selling the premium. And that is what makes it a lot different. You can increase your profit and reduce your risk by simply legging into this position. When you're talking about a naked put, it's a single transaction, and the money that gets cash secured happens automatically by your broker. You don't get to split it up. You don't get the best prices. You can't increase your reward and remove your risk. It kind of limits you. It's not actually as sexy as you want it to be. The real value of cash secured naked puts is when you want to have a stock in your account and you want to control the purchase of it.
We're only interested in sexy trades over here at Trading Trainer.
It's true. I made this spreadsheet, by the way, and you can fill in whatever ticker, expiration date, strike price, and put in the 3 prices. I have this in a Google Sheet. Sip, I think we should offer this spreadsheet so people can play around with these 2 synthetics and see how those comparison works out. I guess anybody could just put a comment in asking for it, and we'll give them the link on how to get a copy of this from our Google Sheets.
Without a doubt. So feel free, if anyone's interested in using this tool, to what would you call this tool? Synthetic equivalent trading strategy. Is there a simpler term for that?
I mean, CC versus NP, right?
Okay, so if you want to determine which strategy you think is going to be sexier, feel free to use this tool. Drop a comment. I think the way you could just duplicate this into your own sheets and use it. So very useful. I know that AJ and the team are working hard on some other sexy tools that hopefully will be releasing later this year that kind of do a lot of the similar stuff here. So we'll kind of just wait on that. But that's, the wonder of being a member here at Trading Trainer, in that there's always new technologies, new tools, new approaches. The one thing that this always brings me back to is this simple concept of trading options. You can do it in 27 different ways. And this is a great example of kind of doing the same type of trade using 2 different strategies, but having just a few differential risk parameters that can really make a big difference.
Absolutely. Absolutely. And I just want to dispel, I mean, God, people are going to come along and they're going to try to woo you to buy their products, buy their, buy their latest education, buy their tools around this strategy. I call it the shiny object syndrome. People are going to say, what you really have to do, and I keep echoing this every week, is you have to analyze, number one, what are you interested in? Are you interested in options, futures, commodities, crypto? Pick something you're interested in, but also pick something that fits your lifestyle, right? If you're out and about during the 6.5 hours that the market is open, or if you're talking about like Forex, the midnight, if you can't be there, then active trading probably is not for you. You want to think about, what sort of investing can you do for your lifestyle? Pick that and then master it, right? You want to master it. Mastering it doesn't mean buying some access to some tools and or, reading a book about it. That's not mastering, right? I the analogy I have is with the workshop. I have a home in Washington D.C., as many of you know, and in the backyard I had a building built, and I call it my workshop, and I had it stocked with a whole bunch of metalworking and woodworking tools. And I have some of the latest tools with like laser alignment and all this shit. And the cool thing is I've got all the books and I read them. But I also have a buddy who has been working in wood and metal for years. I mean, decades. And he comes over and I'm like, hey, look at this tool, this saw. It's got the laser and da da da. And I don't care how many tools or how many books I've read about it. When he and I sit down and he like makes a piece of furniture and I make a piece of furniture, his always comes out way better. Why? Because he's a master at it. I haven't mastered it yet. I might have all these like new tech tools that he actually raises his nose to. I might have all these new tech tools and I might have read all these books about how to do the right technique, but I haven't got the experience, the practice. And so if you want to master something, the key is to put your blinders on and stop being distracted by get rich quick schemes, this marketing, because if it really is that good, if it's too good to be true, it probably is, right? So you pick something like selling premium. That's what we're experts at because we're kind of disciplined, if not lazy investors. You sell premium, you get good at it. Get yourself a free simulator account and you practice until you've mastered it. And don't worry about all the other stuff because that's just going to distract your valuable time from mastering the topic at hand.
Beautiful, AJ.
I mean, I could get on my soapbox all day, Sip.
Yeah, I know, but that's kind of what what you've been doing here at Trading Trainer for almost 2 decades. I mean, 2 decades, and there's a core group of people that are in your community that are analyzing these trades, that are helping each other, and being the lazy trader may not be the sexiest uh, name in the game, but consistency and making profits is, and that's kind of what we're all about.
Yeah.
So with that, I think we're going to be, wrapping up the show here today. As always, if anyone has any questions or comments, feel free to leave them on the platform that you're watching this on. Head over and hit that subscribe button. If you haven't watched AJ's webinar, jump in that ASAP because there's a lot of value in there. And, we're wishing everybody a very positive 2022. It looks like there's going to be a lot of opportunities. And so we're excited to see, others succeed in that area as well.
Absolutely. Thanks, everybody.
So with that, we'll catch you next week, guys.
Take care.